So, how does a company manage to grow its actual sales by, a measly 5.3%, but simultaneously triple the amount of pure cash it generates in the exact same quarter?
Right. I mean, you look at those two numbers side by side on an earnings report, and it honestly looks like a typo.
Yeah, it looks like financial alchemy or something. But today, we are doing a deep dive into the Q2 2026 earnings call for Fidelity National Information Services.
Also widely known under the ticker symbol FIS, just to be clear for everyone.
Exactly, FIS. And that mathematical anomaly is exactly the reality they just presented to Wall Street.
It really is wild when you dig into it.
Right, and you're joining us today because you need the comprehensive, the granular breakdown of the business mechanics behind this stock.
You want the hard data.
Yeah, the hard data, the unvarnished story driving that data, and most importantly, an actionable verdict on what this all means for your portfolio.
We are cutting through all that corporate jargon and diving deep into the plumbing of the global financial system today.
And I love that you use that word because the plumbing analogy is really the most accurate way to look at FIS, right?
Oh, absolutely. I mean, they do not build consumer-facing apps.
No flashy logos on your home screen.
Exactly. They don't have this flashy brand that retail consumers interact with on their smartphones every day.
Right.
They build the deeply embedded, highly complex infrastructure that allows massive global banks to just, function.
So when you swipe a credit card or when a massive hedge fund executes a block trade.
Or when a commercial bank issues a multi-million-dollar loan, right?
Yeah. The software facilitating that action, calculating the risk, and updating the central ledger is very likely run by FIS.
And because they operate strictly behind the scenes like that, their earnings reports offer a fascinating diagnostic view of the broader global economy.
It really is like a pulse check on the financial system, and we are going to look at that diagnostic view today.
And it's a complicated view, let me tell you.
Yeah, I mean, we are going to see a company that is essentially split into two entirely different operational realities right now.
It's like Dr. Jekyll and Mr. Hyde.
Completely. One side of the business is this absolute juggernaut just locking in revenue for the next half decade.
While the other side is stumbling over its own feet.
Yeah, missing sales targets and forcing management to completely slash their growth expectations for the rest of the year.
It's a mess on that side.
So let's start by dissecting the headline numbers, because the contrast between the top line revenue and the bottom line cash flow is really the defining narrative of this quarter.
Right, so let's hit the revenue first.
Okay, so revenue hit $3.4 billion, and on a pro forma basis, that is up 5.3%.
We should probably translate pro forma for a massive corporate behemoth like this, because it's critical.
Yeah, please do, because it sounds like accounting magic to a lot of people.
Well, when a company is as large and, acquisitive as FIS,
Why?
They are constantly buying smaller competitors.
Right, or spinning off divisions.
Exactly. Or selling off assets that just no longer fit their core strategy.
So the raw numbers get messy.
Hopelessly distorted. I mean, if you just look at raw revenue from one year to the next, you might see a 20% drop in revenue.
But that drop was just because they sold off a subsidiary.
Right, not because their actual core business shrank. So pro forma strips out all that noise.
It creates an apples-to-apples comparison.
Exactly, by adjusting for those acquisitions and divestitures.
So when they report 5.3% pro forma revenue growth, we know that the organic underlying business they retained grew by that exact amount.
Which is, a solid, albeit unspectacular, number.
Yeah, it passes the test, but nobody is throwing a parade for 5% top-line growth in the enterprise software space.
No, definitely not. But the profitability metrics are where this narrative shifts completely.
This is where it gets crazy. So adjusted earnings per share, the EPS, grew 9%.
Which landed near the very high end of their expected range.
Right. But more importantly, their adjusted EBITDA earnings before interest, taxes, depreciation, and amortization grew 7.4%.
And within that EBITDA calculation, their margins expanded by 113 basis points.
Which is huge because they were only projecting an expansion of 75 to 110 basis points.
Yeah, they actually beat their own internal efficiency targets.
We really need to contextualize what 113 basis points actually means for a business of this scale, though.
Yeah, because a basis point is just 1/100th of a percentage point.
Right, so 113 basis points is literally 1.13%.
And to a retail consumer, a 1% difference sounds, completely negligible.
But who cares about a penny, right?
Exactly. But in a multi-billion-dollar enterprise business, margin expansion is the holy grail.
It really is.
It means that for every single dollar of that $3.4 billion in revenue they brought in, they kept an extra penny and a fraction in pure profit compared to the previous year.
And when you apply that across a massive revenue base, it results in an enormous influx of actual tangible cash.
Which leads directly into the most staggering data point of the entire call.
The one I mentioned at the very beginning of the deep dive?
Free cash flow.
Yeah, free cash flow. I mean, it didn't just inch upward. It more than tripled year over year in the second quarter.
Tripled. It's just wild.
They are now sitting on a trailing 12-month free cash flow of a massive $2.2 billion.
I think we need to spend some time here because this is where a lot of retail investors get lost in the financial modeling.
Yeah, let's break it down. Because revenue is just money coming in the door.
Right, it's the gross sales.
But free cash flow is what is actually left over after you pay the salaries, keep the servers running, pay the taxes,
and reinvest whatever is necessary to keep the business functioning.
Exactly. So if revenue only grew 5%, but the cash left over at the end of the day tripled, they had to have drastically altered their internal cost structure.
Oh, they executed an absolute masterclass in operational discipline.
James Keto, the CFO, laid out the mechanics of this cash flow explosion very clearly on the call, didn't he?
He did. The first major lever they pulled was structural. They benefited from lower cash taxes.
Which is nice, but it's not really the core business improving.
Right, but the much more sustainable and impressive lever was a highly favorable product mix shift.
Okay, what does that mean in plain English?
It means they are deliberately steering their sales teams and their client onboarding toward higher margin software solutions.
And away from the lower margin, resource-heavy legacy products.
Exactly. Think about it. When you sell a piece of software that can be duplicated and deployed with near zero marginal cost, your profitability skyrockets.
Right, compared to selling a service that requires, flying a team of consultants across the country to manually install something over 6 months.
It's the classic shift from a service-heavy model to a pure software-as-a-service model.
And the margins on software are famously robust once those initial development costs are covered.
Very robust. But there was another component to this cash flow surge, too. They aggressively targeted their own internal bloat.
Yeah, the cost cutting. They reduced their non-GAAP cash expenses by $70 million.
Bring that figure down to $730 million for the quarter.
We should probably break down that term, non-GAAP cash expenses.
Yeah, because GAAP stands for Generally Accepted Accounting Principles.
The standardized set of rules that every public company must follow when reporting to the SEC.
Right. And GAAP rules require companies to include all sorts of non-cash expenses.
Like depreciation of their physical assets.
Or the amortization of goodwill from past acquisitions.
But depreciation isn't a check you write to someone. It's a theoretical loss of value on an asset over time.
Precisely. It doesn't impact your bank account today.
Right.
So management teams will often provide non-GAAP metrics to show investors the actual cash reality of the business.
Because stripping out those accounting-based non-cash charges gives you a clear picture of how much actual cash is moving in and out of the corporate checking account.
Exactly. So when FIS says they reduced non-GAAP cash expenses by $70 million, they are saying they literally spent $70 million less in cold, hard cash to run the business this quarter.
Compared to the same time last year.
Yes. They achieved this by ruthlessly cutting one-time integration cost and transformation expenses.
So they basically stopped spending money on outside consultants to figure out how to merge different corporate cultures from all those past acquisitions.
Right, and they just focused on running the core engine.
I often think about this in the context of like a massive chain restaurant trying to turn its financials around.
Oh, that's a good analogy.
Yeah, because for years, they might have been focused purely on top-line revenue opening new locations, running massive national ad campaigns.
Just trying to get as many people in the door as possible.
Right, so revenue goes up, but the costs to acquire that revenue are astronomical, so the actual profit is incredibly slim.
You're spending $1 to make $1 and a penny.
Exactly. So what FIS did this quarter is the equivalent of the restaurant saying, look, we are going to stop opening new locations.
We're going to fire a layer of middle management.
We are going to renegotiate our contracts with our food suppliers.
And we are going to focus entirely on maximizing the profit of every single burger we currently sell.
And when you do that, the top line sales growth might slow down to a crawl, but the actual cash piling up in the safe at the end of the night completely skyrockets.
That is an excellent framework for understanding value investing in mature enterprise tech.
Because a company does not need to be a hypergrowth tech darling scaling revenue at 40% a year to be a phenomenal wealth-generating asset for shareholders.
Not at all. If you possess a sticky, reliable revenue base, which FIS absolutely does with its core banking clients, and you squeeze the operational costs, your cash flow goes parabolic.
And because they generated so much cash, they were able to dramatically improve their balance sheet, right?
Oh, yeah. They lowered their leverage ratio to 3.5 times.
Yeah.
Let's define that leverage ratio for the listener who might be newer to reading balance sheets. 3.5 times what?
Right. What are the two variables in that equation?
Exactly.
So the leverage ratio we are talking about here is debt to EBITDA.
Okay.
It is the standard metric that bondholders, creditors, and institutional investors use to determine if a company can comfortably service its debt obligations.
You take the total outstanding debt of the company and divide it by their annual EBITDA.
Which again is their earnings before interest, taxes, depreciation, and amortization.
Right. So if a company has $3.5 billion in debt and they generate $1 billion in EBITDA, their leverage ratio is 3.5x.
Meaning it would take them 3.5 years of dedicating every single penny of their core earnings just to pay off the principal of their debt.
Wow. Okay, so in the world of high growth, speculative tech, carrying a lot of debt can be a massive red flag.
Huge red flag. But for a highly mature, heavily entrenched financial infrastructure provider like FIS, a 3.5x leverage ratio is actually incredibly healthy.
Because they possess such immense predictability in their recurring revenue.
Exactly. Creditors view their debt as incredibly safe because of those contracts.
So by bringing that ratio down to 3.5x, they are essentially building a financial fortress.
They are not drowning in interest payments, which frees up all that massive free cash flow to be returned directly to the shareholders.
Which they did aggressively, by the way. They returned $270 million to shareholders in the second quarter alone.
Primarily through dividends.
Yeah. So as a retail investor, you are getting paid a tangible yield simply to hold the stock while management continues to optimize the cost structure.
But, as we transition into the actual business segments generating this cash, the narrative becomes much more complicated.
It really does. Looking under the hood of that $3.4 billion in revenue reveals a company divided right down the middle.
We have to examine the specific operational dynamics of their two main divisions.
So let's look at the undisputed star of the quarter first, the banking and payments segment.
This segment is the absolute bedrock of the FIS investment thesis.
I mean, banking revenue grew by 6.1%, which came in at the very high end of management's outlook.
And this growth was driven by sustained structural momentum in both their core banking software solutions and their payments processing infrastructure.
To really understand the dominance of this segment, we kind of have to look back at one of the most critical strategic moves in the company's history.
You are talking about the TSYS acquisition.
Yeah, the Total System Services buyout. CEO Stephanie Ferris specifically highlighted the total issuing solutions business during the call.
And honestly, you cannot overstate how important that integration has been.
The industry refers to it as TSYS, right?
Right. And it is a massive, incredibly complex piece of the global payments puzzle.
So to understand why FIS bought them, you really have to understand the mechanics of a simple credit card transaction.
Exactly. When you buy a coffee, there are multiple financial institutions involved in the fraction of a second it takes for the terminal to approve the transaction.
There is the merchant's bank, known as the acquiring bank, which wants to pull the money in.
And then there is your bank, the bank that actually gave you the credit card, known as the issuing bank.
Right. And when a massive consumer bank like, say, Capital One or Chase issues millions of credit cards, they do not want to build the back-end software required to track every single customer's credit limit.
Oh, absolutely not. Or authorize every individual transaction in milliseconds.
Or calculate the complex reward point algorithms and generate the monthly statements.
Building and maintaining that infrastructure from scratch is a logistical nightmare.
With massive regulatory compliance risks.
So they outsource it. They hire a company that specializes in issuing solutions to run the entire back end of their credit card portfolio.
And for decades, TSYS was the undisputed king of that issuing market.
So when FIS acquired them, they weren't just buying a software product, they were buying access to a massive, rapidly compounding global market for issuing credit and debit cards.
Because prior to the acquisition, FIS was incredibly strong in core banking ledger software, but they didn't have a dominant foothold in the card issuing space at scale.
Right. They needed that piece of the puzzle.
And the strategic genius of the acquisition was the client overlap.
Yes. FIS was already selling core ledgering software to the biggest banks in the world.
And TSYS was already selling card issuing software to those exact same banks.
So the thesis was cross-selling.
If you already trust us to run your central ledger, you should also trust us to run your credit card portfolio.
And we will integrate the two systems so they communicate flawlessly.
And according to the data FIS presented, that thesis is working beautifully.
She noted that 72 of their top 100 clients are now deeply integrated across multiple FIS platforms.
Wow. And the compounding effects of that integration are really showing up in the new business wins.
During the quarter, they signed 2 massive new financial institutions to their issuing platform.
Yeah, they won a top 10 Latin American bank, and they secured a top 10 private sector commercial bank in India.
And winning international business at that tier is incredibly difficult.
I can imagine.
It requires demonstrating that your software can handle localized regulatory frameworks, multi-currency conversions, and massive transaction volumes without a single point of failure.
But, the data point from the banking segment that absolutely jumped off the page for me, the number that every single retail investor needs to circle in red ink is the contract lock-in.
Oh, the renewals.
Yes. FIS mentioned that since the start of the year, they have successfully renewed a full third of their total issuing revenue.
And because of those successful renewals, a staggering 72% of their total revenue in that portfolio is now under contract through 2029 or beyond.
That number was previously sitting at 65%, right?
Yes. So pushing it to 72% is a monumental achievement in enterprise sales.
Having nearly 3/4 of your revenue contractually guaranteed for the next 3 to 5 years is it's the holy grail of software economics.
It provides a level of financial predictability that most companies can only dream of.
I really want to make the reality of these switching costs incredibly tangible for everyone listening.
Good idea.
We hear the term sticky revenue thrown around constantly in tech analysis. But why is it so sticky?
Right. Why doesn't a bank just leave?
Yeah, why doesn't a massive global bank simply wake up one morning, decide they're tired of paying FIS's subscription fees, and migrate their entire operation to a cheaper, modern startup?
Well, think of a legacy Tier 1 bank's core infrastructure as the foundational concrete of a massive skyscraper.
Okay, I like that visual.
That core system holds millions of individual customer accounts. It executes daily interest calculations across hundreds of different financial products.
And it is hardwired into federal regulatory reporting system.
Exactly. You cannot just pull the foundation out from under the skyscraper.
It would collapse.
If a bank wants to switch vendors, they essentially have to build temporary load-bearing walls, painstakingly migrate the plumbing floor by floor,
and ensure that not a single penny is lost in the transfer.
It is a multi-year, multi-$100 million endeavor fraught with catastrophic risk.
Because if a migration fails, accounts freeze, customers panic, and federal regulators step in immediately.
Exactly. The risk of failure vastly outweighs the potential cost savings of switching to a new vendor.
Banks are fundamentally risk-averse institutions.
So when FIS successfully implements a system for a mega bank, and that system runs flawlessly day in and day out, the bank is more than happy to sign a 5-year renewal.
They are paying for stability, security, and the peace of mind that their core infrastructure will not collapse.
Which completely neutralizes a lot of the bearish market chatter surrounding FIS's competitive threats.
Yeah, because analysts often point to agile cloud-native startups like Pismo or massive network operators like Visa as potential disruptors who will come in and steal market share from legacy providers like FIS.
But FIS addressed that exact fear head-on during the call.
She pointed out that Visa's own CEO publicly admitted their target demographic for new issuing solutions is small to mid-sized banks and emerging fintech startups.
Visa is not currently equipped to walk into the boardroom of a top 3 global bank and offer to rip out their entire core infrastructure.
No, it is entirely a game of scale and proven execution.
Pismo might build a beautiful modern API that wins over a trendy new neobank with 50,000 customers.
Sure.
But a neobank's infrastructure requirements are child's play compared to a legacy institution with 50 million accounts.
Accounts spanning retail checking, commercial lending, wealth management, and international trade finance.
Right. And FIS has an 85% win rate on contract opportunities involving more than 1 million accounts.
85%.
They own the enterprise space because they're the only ones with the institutional muscle to actually execute a migration of that magnitude.
And that is why their enterprise-wide cross-selling to Jort clients grew an incredible 35% year over year in the first half.
So the banking and payments division is a well-oiled machine, generating highly predictable, locked-in cash flows.
But that is only half the story.
Unfortunate.
Yeah, if banking is the star student locking down early admission to an Ivy League university, we have to look at the other side of the report card.
We have to examine the problem child.
The capital markets segment. Because this is where the earnings call shifted from a victory lap into a very, very uncomfortable autopsy of operational failure.
The contrast is genuinely jarring. While banking thrived, the capital markets segment grew a meager 3.2%.
And that figure sat at the absolute bottom edge of their management outlook.
To understand the failure here, you have to understand what this segment actually does.
Right. What is capital markets software?
It's deployed across trading floors, asset management firms, lending departments, and corporate treasuries.
It handles complex risk modeling, derivatives processing, and syndicated lending operations.
It is dense, heavily regulated, and incredibly complex software.
In the first half of the year, this segment generated $1.6 billion in revenue, and roughly 74% of that was recurring revenue from existing subscriptions.
So the recurring revenue was stable, but the growth engine completely stalled out.
And the ugliest number in the entire transcript is the professional services revenue within this segment.
It didn't just slow down, it completely cratered.
It dropped 17% year over year.
17%.
Now, management pointed to a few external factors to explain the broader slowdown.
They cited a 1% headwind resulting from UBS acquiring Credit Suisse.
Right, because when two massive global banks merge, they inevitably consolidate their redundant software systems.
And UBS chose to sunset certain FIS platforms that Credit Suisse was using, resulting in a direct loss of recurring revenue.
But that merger was a known variable. Wall Street had already baked that 1% headwind into their models.
True. They also faced severe macroeconomic headwinds in their lending software division.
Because when interest rates are hovering near multi-decade highs, the volume of massive commercial loans plummets.
Corporations delay capital expenditures. They don't take out loans to build new factories or acquire competitors because the cost of capital is too punishing.
And FIS's lending software generates revenue based partially on the volume of loans processed.
Right. They were relying on the lending division to contribute a full point of organic growth to the segment, and that growth completely evaporated due to the frozen macro environment.
Okay, so the UBS merger was bad luck, and the interest rate environment is completely outside of their control.
We can forgive those misses.
But let's dig into that 17% drop in professional services, because management did not blame the macroeconomy for that one.
No, they did something you almost never see on a public earnings call.
They explicitly fell on their sword. Stephanie Ferris and James Keogh both stated point blank, the miss is on us.
It is remarkably rare to hear that level of blunt accountability.
They admitted to a catastrophic combination of two distinct operational failures within the capital markets division.
First, their sales teams simply missed their quotas in the first half of the year. They failed to close enough new business deals.
And second, they had a robust existing backlog of projects signed in late 2025, and their engineering teams completely fumbled the implementation schedule.
They failed to install the software as quickly as they promised the clients.
Let's break down the mechanics of enterprise software revenue recognition, because a 17% drop in professional services revenue is deeply tied to how these deals are structured.
It's not like consumer software.
Right. In the enterprise space, you don't just buy a software license, download it from the cloud, and start using it the next day.
The software requires massive customization, integration with legacy databases, and rigorous security testing.
And that customization and installation process is what professional services actually means.
When FIS sells a new trading platform to an asset manager, they also sell thousands of hours of consulting and engineering labor to actually build the customized architecture on the client servers.
Those implementation engineers bill their time by the hour, or the contract dictates massive payment milestones upon the completion of specific installation phases.
So if the sales team completely whiffs their quota in Q1, There is no new software to install in Q2.
Your army of highly paid implementation engineers suddenly sitting on the bench.
You are paying their six-figure salaries, but they are not billing any hours to clients.
The professional services revenue dries up instantly.
And the second failure, fumbling the existing backlog, is arguably even worse.
How so?
Well, let's say the sales team did their job in Q4 the previous year. They sold a massive contract. The client expects the software to be fully installed and operational by June.
Okay.
If the FIS implementation team is disorganized, understaffed, or runs into technical roadblocks, and that installation gets delayed until October, FIS cannot recognize the revenue for those critical installation milestones in Q2 or Q3.
The revenue gets pushed out into the future.
Exactly.
And Keogh highlighted a crucial mathematical reality about how this impacts the full year.
He pointed out that any software sold in the first half of the year typically converts to recognized revenue at about a 75% rate within the current calendar year.
So by missing those early sales targets and delaying the backlog implementations, that revenue doesn't just shift to Q4, it gets permanently vaporized for the 2026 fiscal year.
You cannot go back in time and bill those lost hours.
That is the brutal reality of professional services. It is human capital intensive, and time is the ultimate perishable inventory.
If an engineer doesn't bill an hour on Tuesday, you can never get that Tuesday back.
So the capital markets division suffered from a lethal combination of missing the initial sales and then failing to execute the work they actually did have on the books.
It's a massive unforced error.
However, before we write a complete obituary for the growth prospects of this company, we need to examine the third major pillar of this earnings report.
It is the catalyst that I believe is secretly driving that incredible margin expansion we discussed earlier.
It is the AI kicker.
Oh yes, the AI.
Every single company on the S&P 500 is slapping the phrase artificial intelligence onto their earnings call transcripts, hoping to get an algorithm bump in their stock price.
Most of it is pure vaporware, to be honest.
But FIS is actually presenting hard, verifiable internal metrics on how AI is radically altering their cost structure.
Because FIS operates the central nervous system for thousands of financial institutions, they sit on an ocean of proprietary data.
They process the payments, they see the lending flows, they manage the capital markets trading data.
And as the entire enterprise software industry races to implement AI, proprietary data is the only true competitive moat.
Right, because anyone can rent processing power from Amazon or Microsoft.
Anyone can license a large language model.
But you cannot train an AI to understand the incredibly nuanced, highly specific logic of a legacy COBOL banking system unless you actually own the data flowing through that system.
Exactly. Ferris mentioned they currently have 10 specific AI-driven products already in the market, with a development pipeline of over 500 distinct opportunities.
But the external products aren't what blew me away.
What was it?
The internal operational metrics are staggering. They reported a 1.5 to 2 times increase in engineering throughput alongside a 30% reduction in software defects.
Think about the unit economics of those numbers.
It's crazy.
If you can double the speed at which your software developers write code, test features, and deploy updates, while simultaneously reducing their error rate by a third, the sheer cost savings are astronomical.
You can build twice as much product with the exact same headcount.
But the truly revolutionary efficiency gains are happening on the customer service side of the business.
Yeah, they launched 5 specific internal programs utilizing what they call agentic AI.
We need to clearly define the difference between a standard AI chatbot and an agentic AI because the distinction is the key to their margin expansion.
Absolutely. Because a standard AI chatbot, like the customer service bots we all interact with online, is essentially a highly advanced search engine.
Right. If a banking client submits a support ticket saying our daily ledger reconciliation failed to process, a standard chatbot might analyze the text and reply with a link to a troubleshooting manual.
Or it might suggest 3 common fixes.
It provides information, but a human engineer still has to read the manual, log into the server, and actually execute the fix.
It's just a digital librarian. It points you to the answer, but you still have to do the work.
An agentic AI goes vastly beyond information retrieval. It has agency.
Meaning it is granted the necessary security permissions to interact directly with the software environment.
Yes. So when that same error ticket comes in, the agentic AI can read the error log, diagnose the root cause of the ledger failure,
automatically write the script required to fix the corrupted data,
execute that script in the live production environment,
verify that the ledger is now reconciled,
and close the support ticket, all without a single human being ever touching a keyboard.
That is wild. And the impact of that capability is spelled out clearly in the data they provided.
Because they deployed these agentic AI programs, FIS reduced their manual service tickets by an astonishing 70%.
70%. Furthermore, the triage time, the time it takes for the system to identify exactly what is wrong when an error occurs, is down nearly 75%.
As a retail investor analyzing this stock, this is the exact moment where the puzzle pieces snap together.
This is the direct mechanism driving the massive free cash flow generation.
When your manual support tickets drop by 70%, you do not need to employ a massive army of Tier 1 support engineers.
You do not need to constantly expand your offshore call centers.
You are aggressively severing the historical link between revenue growth and headcount growth.
Because in the past, if FIS signed 10 new banks, they had to hire 50 new support staff to handle the increased ticket volume.
With agentic AI handling the vast majority of routine errors, they can scale their revenue without scaling their labor costs.
That is pure margin expansion.
That is how you widen your EBITDA margins by 113 basis points, while top-line revenue only grows 5%.
They noted that they currently have over 40,000 active AI co-pilot users internally, generating over 16 million assisted actions.
They are also moving their partnership with Anthropic into full execution mode.
They are leveraging Anthropic's models to build regulatory-grade, AI-powered anti-money laundering and fraud detection capabilities.
And fraud detection is traditionally an incredibly labor-intensive process, requiring massive teams of analysts to review flagged transactions manually.
If AI can automate that analysis with higher accuracy than humans, the operational savings will be immense.
It creates a fascinating dynamic for the company as a whole. You have a booming, highly predictable banking segment.
You have a stumbling, poorly executed capital markets segment.
And underneath both of those, you have a radical internal AI revolution driving unprecedented operational efficiency.
Which is why this complex dynamic forces us to look closely at Section 3 of our deep dive, management guidance.
When a company has such conflicting operational realities, how do they set expectations for Wall Street for the remainder of the year?
Right. The narrative of their updated guidance is a story of lowering the ceiling but simultaneously raising the floor.
Let's look at the ceiling first. Management had to come out and drastically lower their full-year revenue expectations.
They dropped the total revenue guidance to a range of 4.5% to 5%.
They had previously told investors to expect 5.1% to 5.7% growth.
And that reduction is almost entirely the fault of the capital markets disaster.
They took a massive hatchet to the capital markets growth expectations.
3 months prior, they were projecting that segment to grow at 5.5%. For the year.
They slashed that expectation all the way down to a range of 3% to 3.5%.
A 225 basis point reduction in growth for a major business segment midway through the fiscal year is a brutal reality check.
It is an acknowledgement that the professional services backlog is deeply damaged and cannot be salvaged before December 31st.
But then, in the very same breath, they raise the floor.
Despite acknowledging that they will bring in less total revenue than they initially promised, they actually increased their free cash flow guidance by $100 million.
They are now targeting a massive $2.15 billion to $2.25 billion in pure free cash flow for the year.
At the midpoint of that new range, it represents 36% growth in free cash flow year over year,
which is significantly higher than their previous outlook of 30% growth.
This brings up the ultimate reality check for the retail investor listening to this breakdown.
Yeah, if a management team stood on a stage 3 months ago, looked investors in the eye, and promised 5.5% growth in a major segment,
and then 3 months later had to admit they were wildly wrong, missed their sales targets, and fumbled their implementation schedule.
Why should I trust a single number they give me today? Why should I believe they are suddenly capable of managing this business accurately?
It is the most valid question an investor can ask when faced with a guidance cut.
So how do we answer it?
Well, if we look at how institutional markets operate and how Wall Street prices and risk, institutional investors actually respect a management team that refuses to sugarcoat operational failures.
Because the worst thing a management team can do is pretend a problem doesn't exist, use accounting gimmicks to hide the revenue miss, and then shock the market with a catastrophic earnings miss in Q4.
Exactly. They took their medicine early. Okay. They admitted the failure, absorbed the reputational hit, and reset the baseline to reflect the harsh reality of their sales miss and the difficult macro lending environment.
And more importantly, they proved that their operational discipline is entirely decoupled from top-line sales growth.
They essentially told Wall Street, we failed to sell as much software as we modeled. Our revenue will be lower. But our internal efficiency driven by those AI initiatives, the product mix shift, and the aggressive cost cutting is so robust that we are still going to put an extra $100 million of pure cash in the bank anyway.
And Wall Street will forgive a temporary top-line sales miss if you can prove that the bottom-line cash generation is structurally protected.
And they aren't just sitting back and hoping capital markets fixes itself either.
No, Stephanie Ferris announced a formal strategic review to potentially sell off underperforming or non-core products within that specific segment.
During the Q&A session, an analyst pressed her on the scope of this review.
She declined to give a specific dollar amount regarding the assets they might sell, but she clarified that they are not looking to divest the entire capital markets division.
They're just going to prune the dead weight.
The pruning analogy is perfect. When you acquire multiple companies over the years, you inevitably acquire weird, niche software products that do not fit your core overarching strategy.
Ferris mentioned that they are looking closely at specific standalone risk management solutions or isolated data analysis tools that do not naturally integrate into their broader ecosystem.
If a software product is not a vital payment rail, if it is not a foundational ledger, and if it requires a massive amount of specialized sales effort for very little growth, it is a distraction.
Selling off those low-growth, low-margin products will immediately boost the overall growth rate and margin profile of the remaining segment.
It signals to the market that they are taking aggressive action to return capital markets to mid-single-digit growth by the 2027 fiscal year.
Which brings us to the ultimate conclusion of this deep dive.
We have analyzed the massive cash flow surge.
We have explored the impenetrable moat of the banking segment.
We have diagnosed the self-inflicted wounds in capital markets.
And we have evaluated management's strategy for navigating the rest of the year.
So what is the actionable verdict for the retail investor who is managing their own portfolio?
The verdict requires extreme clarity regarding what kind of asset this is.
If you are an investor looking for the next NVIDIA, if your portfolio strategy relies on finding hyper-growth tech rockets that are going to double their top-line revenue in the next 24 months, FIS is fundamentally incompatible with your strategy.
Do not buy this stock hoping for massive, disruptive top-line expansion.
Our stance is cautiously bullish, but strictly as a cash flow value play.
Let's separate our actionable advice into two camps. First, what is the strategy for the investor who already holds FIS in their portfolio and is staring at a slashed guidance report?
If you are currently a shareholder, the mathematical data demands that you stay the course.
Do not let the headlines regarding the capital markets mistrigger a panic sell.
The foundational thesis of this company remains entirely intact. The core banking and payments business is a fortress.
We discussed the astronomical switching costs associated with moving a Tier 1 bank off an FIS ledger.
That 72% contract lock-in stretching all the way through 2029 provides a massive structural floor underneath the stock price.
You are insulated from massive client churn.
The downside risk is heavily mitigated by those contracts. And while you wait for management to prune the dead weight in capital markets and fix the implementation backlog, you are being heavily compensated.
You are holding a company with a 3.5x leverage ratio that is actively returning hundreds of millions of dollars to you via dividends.
You're getting paid to wait out a temporary operational glitch.
Now, what about the investor who is sitting on cash, looking at the market, and considering initiating a new position in FIS after this mixed earnings report?
For the potential buyer, you have to understand that you are buying into a cash printing machine that is currently being penalized for a localized failure.
The management team laid out a highly credible, mathematically sound pathway to generating greater than $3 billion in pure free cash flow by the year 2028.
When a company with a predictable contracted revenue base targets $3 billion in annual free cash flow, it provides them with a massive arsenal of capital allocation options over the next 4 years.
They have the ammunition to steadily increase the dividend yield, execute aggressive share buyback programs that artificially drive up the price per share by reducing the supply, and further reduce their debt load.
All three of those actions inherently drive immense shareholder value, regardless of whether the top-line revenue is growing at 4% or 7%.
The caveat for the buyer is patience.
The third and fourth quarters of this current 2026 fiscal year might look quite messy on paper.
When they execute this strategic review, announce the sale of those underperforming capital markets assets, and take whatever write-downs are necessary to clear the implementation backlog, the quarterly headlines might be bumpy.
But if you are operating on a 3 to 5 year time horizon, buying into a deeply entrenched, highly profitable infrastructure monopoly while it is temporarily out of favor due to a fixable operational error is the definition of a winning value investing strategy.
You are purchasing the massive cash flow yield today, and you are placing a calculated bet that the structural dominance of the banking segment provides them with ample runway to reorganize and fix the capital markets segment.
I think that perfectly encapsulates the current reality of the stock. But before we wrap up this deep dive, I want to pivot slightly and leave you with a broader, more provocative industry trend to mull over.
Something that builds on all the data we just analyzed, but looks further over the horizon regarding FIS's ultimate position in the global financial infrastructure.
During the Q&A portion of the call, one of the analysts brought up a massive structural trend occurring in enterprise banking known as hollowing out the core.
We talked earlier about the skyscraper metaphor, how terrified legacy banks are of ripping out their foundational COBOL ledgers.
Right. Because they refuse to replace the foundation, they are instead trying to modernize by hollowing out the old core.
They are building modern, agile technology layers around the edges of the old system to handle fast, customer-facing applications, while keeping the ancient ledger buried deep inside, purely for final record-keeping.
It is essentially a massive, industry-wide technological Band-Aid.
They are building a sleek, modern smartphone interface that secretly connects to a mainframe from 1985.
And FIS is sitting on an absolute gold mine regarding this specific trend.
Because they are the ones who installed that 1985 mainframe in the first place, they are uniquely positioned to build the modern layers surrounding it.
They aren't just an outside vendor trying to guess how the legacy code works. They are the central nervous system.
Stephanie Ferris specifically highlighted that FIS possesses a modern cloud-native banking platform, and they recently acquired an orchestration platform specifically designed to help these mega banks modernize from the inside out.
We should define what an orchestration platform actually does in this context.
If a bank has a modern mobile app for consumers, an entirely different software suite for commercial lending, and a 40-year-old core ledger keeping track of the money, those systems cannot naturally communicate with each other.
An orchestration platform sits in the middle like a universal translator.
It takes a request from the modern mobile app, translates it into the archaic code required by the legacy ledger, extracts the answer, and translates it back to the mobile app in milliseconds.
It allows banks to deploy modern features without ever touching the fragile underlying core.
By acquiring and integrating that orchestration layer, FIS is offering banks the ultimate low-risk modernization strategy.
But let's take this one step further and connect it to the AI metrics we discussed earlier.
We know that FIS is successfully using agentic AI internally to diagnose errors, rewrite code, and drive down their own manual service tickets by 70%.
They are making their own massive, complex operations radically efficient.
Imagine the revenue potential when FIS stops using that AI purely for internal cost savings and begins packaging that exact same AI efficiency as a premium enterprise-grade product to sell to the world's largest banks.
The margin profile on an enterprise AI product trained on proprietary banking data would be astronomical.
The banks are desperate for operational efficiency, but they cannot use off-the-shelf AI models because of regulatory and security constraints.
FIS can offer them a regulatory-grade, pre-trained AI agent that already natively understands the orchestration layer and the legacy core.
If FIS successfully proves they can use AI to manage the complexity of massive financial infrastructure internally, they become the undisputed, trusted partner to deploy that same AI for JP Morgan, Citibank, or the massive Latin American and Indian commercial banks they just signed.
This raises a profound question about the ultimate long-term valuation of this company.
Is FIS secretly transforming?
Are we witnessing a legacy, low-growth payments processor slowly morphing into the dominant, highly efficient AI infrastructure play for the entire global financial sector?
It is a highly compelling long-term thesis. AI models are only as valuable as the data they are trained on.
FIS sits on a proprietary data asset, seeing the real-time flows of global payments, massive commercial lending, and capital markets trading that no tech startup can ever replicate.
If they successfully monetize that data through customized agentic AI solutions for their massive client base, that $3 billion free cash flow target for 2028 might end up looking incredibly conservative in retrospect.
It is a massive structural transition hiding beneath a messy earnings report, and it is something every investor needs to seriously model out before they make a final decision on this stock.
The muddy waters of a mixed earnings report might actually be hiding a very deep well of future value.
Thank you for joining us on this comprehensive deep dive into the underlying mechanics of FIS.
Our goal is always to cut through the noise, examine the hard data, and understand the real forces driving shareholder value.
Keep digging into the numbers, stay objective in your analysis, and we will catch you on the next deep dive.